Hello, everyone. Welcome to our lecture on valuation foundations. Today, we will build one of the most important ideas in finance. Value comes from future cash flows brought back to today. That sentence is simple, but it is powerful. When we value a bond, a stock, a project, or even an entire company, we are really asking three questions. How much cash flow do we expect? When will that cash flow arrive? How risky is that cash flow? Finance gives us a disciplined way to connect those questions. A dollar expected next year is not the same as a dollar today, because time matters. Risk matters too. If the future is uncertain, investors require compensation for bearing that uncertainty. So the basic valuation idea is this: value today equals the present value of expected future cash flows. We discount future cash flows using a required return. That required return reflects the opportunity cost of capital and the risk of the asset. In this lecture, we will apply that logic to bonds, stocks, and discount rates. By the end, you should see that valuation is not just a formula, it is a way of thinking clearly about cash flows, risk, timing, and growth. Let us begin with the present value logic of valuation. A financial asset is a claim on future cash flows. A bondholder expects coupon payments and repayment of principal. A stockholder expects future dividends, repurchases, or a sale price supported by the firm's future cash generation. A lender expects promised payments from a borrower. A project investor expects future operating cash flows. The broad valuation formula says that value today is the sum of expected cash flows, each discounted back to the present. In words, we take each future expected cash flow, divide it by 1 plus the required return raised to the proper time period, and then add everything together. This is why timing is so important. Cash flow expected soon is discounted less. Cash flow expected far in the future is discounted more. This is also why risk is so important. A higher required return reduces present value. Now, we should separate price from value. Price is what the asset trades for in the market. Value is an estimate based on expected cash flows and required returns. In competitive markets, price and value may be close, but they are not the same idea. A good financial manager does not simply observe a price and stop thinking. A good manager asks, what assumptions support that price? Valuation is not only an investment topic, it is also a managerial discipline. When a firm raises capital, investors value the securities the firm issues. When a company considers an acquisition, managers value the future cash flows of the target. When a firm evaluates a new product, managers ask whether the present value of future benefits is greater than the investment required today. So valuation is not just something analysts do on Wall Street. It is something managers use to make decisions. The same three questions appear again and again. How much cash flow is expected? When will the cash flow occur? How risky is the cash flow? The first question is about forecasting. We must estimate the amount of cash flow. The second question is about timing. A cash flow received sooner is generally more valuable than the same cash flow received later. The third question is about risk. Riskier cash flows require higher returns, and higher required returns lower present values. This is why valuation requires both mathematics and judgment. The mathematics gives structure. The judgment determines whether the cash flow forecasts, discount rates, and growth assumptions make sense. In this lecture, bonds and stocks will help us see the logic clearly. Bonds are useful because many of their promised payments are specified by contract. Stocks are useful because their future cash flows are more uncertain and depend on business performance. Now, let's turn to bonds. A bond is a debt security. The issuer borrows money from investors and promises to make specified payments. A typical bond has two main cash flows. First, coupon payments. These are periodic interest payments made to bondholders. Second, face value repayment. This is the principal amount repaid at maturity. It is also called par value. For a plain annual coupon bond, the coupon payment equals the coupon rate multiplied by the face value. So, if a bond has a face value of $1,000 and a 6% annual coupon rate, the annual coupon is $60. The value of the bond is the present value of its remaining coupon payments plus the present value of the face value repayment. This means a bond combines two familiar present value ideas. The coupon payments are an annuity because they are usually equal payments over time. The face value is a single future cash flow paid at maturity. So, bond valuation is a direct application of present value and annuity logic. If coupons are paid semi-annually, we must match the timing in the model. We use half the annual coupon, half the quoted annual yield, and twice the number of years to maturity. The rule is simple. The period used for the discount rate must match the period used for the cash flows. A central idea in bond valuation is yield to maturity. Yield to maturity is the discount rate that makes the present value of the bond's promised cash flows equal to its current price, assuming the bond is held to maturity and all promised payments are made. Conceptually, yield to maturity is like the internal rate of return on the bond's promised payments. This is very important. The yield to maturity is not the same as the coupon rate. The coupon rate determines the dollar coupon payment. The yield to maturity is the market required return embedded in the bond's price. For many traditional bonds, the coupon payment is fixed, but market conditions change, interest rates change, inflation expectations change, credit conditions change, the issuer's risk can change, liquidity can change. When the required yield changes, the present value of the fixed promised payments changes. This leads to one of the most important bond relationships. Bond prices and yields move in opposite directions. When the required yield rises, the present value of the bond's promised cash flows falls. When the required yield falls, the present value of the bond's promised cash flows rises. This inverse relationship is not just a technical detail. It explains why existing bonds can lose value when market interest rates increase and gain value when market interest rates decrease. Bond prices can be described as premium, discount, or par. A premium bond sells for more than face value. This happens when the coupon rate is greater than the yield to maturity. Investors are willing to pay more than face value because the bond's coupon payments are attractive relative to the current required return. A discount bond sells for less than face value. This happens when the coupon rate is less than the yield to maturity. Investors require a lower price because the coupon payments are low relative to the return currently required in the market. A par bond sells at face value. This happens when the coupon rate equals the yield to maturity, assuming the bond is priced immediately after a coupon payment and has no special features. These labels are not labels of quality. A discount bond is not automatically bad. A premium bond is not automatically good. The classification simply describes the relationship between coupon rate, yield to maturity, and price. Now consider zero coupon bonds. A zero coupon bond makes no periodic coupon payments. Its only promised cash flow is the face value paid at maturity. So its value is the present value of a single future amount. Zero coupon bonds make the valuation logic very clean. The investor pays less than face value today and receives face value at maturity, assuming the issuer pays as promised. Because all cash flow arrives at maturity, zero coupon bonds can be very sensitive to changes in required yields, especially when maturity is long. Now, let's move from bonds to stocks. Common stock represents an ownership claim on the residual cash flows of a firm. This means stockholders are paid after operating costs, taxes, reinvestment needs, and obligations to creditors have been addressed. Unlike a plain bond, common stock usually does not promise fixed payments. But the basic valuation logic is still the same. The value of a share is the present value of future cash flows expected by the shareholder. For a 1-year holding period, the value of a share today equals the expected dividend next year plus the expected selling price next year, discounted back at the required return on equity. For a multi-year holding period, the same idea extends. We discount each expected dividend, and we also discount the expected selling price at the end of the holding period. But here is the deeper point. That future selling price depends on what future investors expect to receive after that date. So, in theory, the value of common stock can be expressed as the present value of all expected future dividends. This does not mean a company with no current dividend has no value. A firm may still be valuable if investors expect future dividends, repurchases, a future sale price, or cash distributions supported by future free cash flow. The dividend model is a clean way to introduce stock valuation logic, not the only way valuation is done in practice. A common simplifying model for stock valuation is the constant growth dividend discount model, also called the Gordon growth model. This model assumes that dividends grow at a constant rate forever. The formula is price today equals next period's dividend divided by the required return on equity minus the growth rate. In symbols, P0 equals D1 divided by the required return minus G. This is a growing perpetuity applied to equity dividends. The condition is very important. The required return on equity must be greater than the growth rate. If the perpetual growth rate is greater than or equal to the required return, the model does not produce a meaningful finite value. Economically, this makes sense. No company can grow faster than the economy forever. Long-term growth assumptions must be conservative and realistic. The model also gives us a useful expected return relationship. Required return on equity equals dividend yield plus growth rate. Dividend yield is the next expected dividend divided by today's price. The growth rate is often interpreted as the expected capital gains yield when the model's assumptions hold. The model highlights the drivers of stock value. A higher expected next dividend increases value. A higher required return lowers value. A higher sustainable growth rate increases value as long as the required return remains greater than growth. This is why equity valuation can be very sensitive. Small changes in risk or long-run growth can create large changes in estimated value. Let's now compare bonds and stocks. Both bonds and stocks derive value from expected future cash flows. But the nature of those cash flows is different. A bond has contractual cash flows. The issuer promises coupons and principal repayment unless default occurs. A stock has residual cash flows. Stockholders receive value only after other obligations are satisfied. A bond usually has a stated maturity date. Common stock usually has no fixed maturity. A bondholder is senior to common equity. This means bondholders have a higher priority claim than stockholders. Stockholders are junior claimants, so they bear more business risk. For bonds, valuation often focuses on yield to maturity or the required return on debt. For stocks, valuation focuses on the required return on equity and expected growth. The main uncertainties are also different. For bonds, important risks include default risk, interest rate risk, reinvestment risk, and liquidity. For stocks, important uncertainties include future earnings, growth, payout policy, competition, and overall business risk. Because equity is a residual claim, investors usually require a higher expected return on equity than on debt issued by the same firm. That higher expected return reflects greater uncertainty and lower priority. For managers, this comparison is crucial. Debt and equity are both sources of capital, but investors value them differently because the promises, risks, and cash flow patterns are different. Let's bring everything together with discount rates, risk, growth, and managerial interpretation. The discount rate is the return investors require to hold an asset with a particular pattern of timing and risk. A simple way to think about it is Required return equals risk-free rate plus risk premium. The risk-free rate compensates investors for the time value of money in a setting with minimal default risk. The risk premium compensates investors for uncertainty. For bonds, the required return may reflect market interest rates, inflation expectations, issuer credit risk, liquidity, and contract features. For stocks, the required return may reflect business risk, financial risk from debt, competitive position, growth uncertainty, and investor expectations about the equity market. A higher required return lowers present value. This effect is strongest for cash flows far in the future. Growth can increase value, but only when it is economically sustainable. Growth that consumes too much cash, requires too much reinvestment, or adds too much risk may not create value. This is the managerial lesson. Valuation translates expectations into present value terms. Capital is not free. Risk affects value. Growth must be funded. Market prices embed assumptions, and valuation is sensitive to inputs. A good valuation analysis combines formulas with judgment. The formulas impose discipline. The judgment determines whether the assumptions are reasonable. Thank you for joining me today. I look forward to seeing you in the next video.